Hey, thanks for joining me for today's call. I'll be quick on this call. We had a question that came in, and thanks for the question. It was, why did I choose to do a fund instead of a syndication? Which why did we do that for Bell Capital? And that's a great question. A lot of people, it's called a blind raise when you're doing a fund, right? So you don't ultimately have a deal yet instead of doing a syndication. So number one, everyone that is like, blind raises and doing a fund is a lot harder if you don't have a deal picked out. So a lot of people like to go the syndication route. But here's the difference between that. I'll go over a couple of things. Usually, a syndicator finds a deal first and then they raise the money. So that's typical. But the challenge with that is there's a lot less certainty in that because brokers, the higher up the food chain you go on brokers, and the higher up the food chain you go on the actual owners, the sellers. There's a lot less certainty in you in that situation, unless you've been doing this for a really long time and you've already done a ton of deals with them. They trust your ability to go and syndicate or raise the money from investors that you don't have the money already. So a lot less certainty, which means that in their eyes, you're a little bit more of a risk. Your risk profile is higher. So that's number one, is that there's less certainty with them. Number two, which really falls within the line of that risk, is that they see you as the fear of not closing. Like if we go back right back to certainty, like usually people think in commercial real estate or multifamily real estate that it's price, but really it's not. It's certainty of close. Like if you ask any owner, broker, seller, myself included, whenever we were selling off our multifamily deals, people were like, what's important to you? And we're like, certainty of close. Price, as a matter of fact, on one of our deals, we actually took less price, but we did it with somebody who we knew for a fact that can close, and they had all the money. They were all cash. So that certainty of close, fear of not closing is huge for syndicators, especially if you take a look at what happened over the last few years. Um, a lot of people closed or they couldn't close and they got deals that were tied up and they lost earnest money deposits on some of these bigger deals, which was their investors' money or their money, and they couldn't close. So a lot of sellers went through that experience. And then the next is that they don't always get the best deals, and I kind of wrote this down. Kind of, it was a great question. So imagine if somebody were to come to you, you have a 20 or 30 or $50 million deal, $100 million transaction, and your company's got this property ready, your property manager's got it ready. Who would you pick? I mean, let's just take off the real estate. Let's just say you had a car, you wanted 20,000 for your car, and somebody says, "Hey, I'm gonna go to my credit union and I'm gonna get a loan, or I'm gonna go to my bank and I'm gonna get a loan." Or somebody comes and goes, "Look, you want 20,000, here's the money, I have it. And will you take 17 or 15?" Like you're just going to wheel and deal a lot better with somebody who showing you or has cash in hand or the commitments in hand. It's just a whole different ball game, and that's the situation that when syndicators have to face. So that's why I chose the fund model, right? The doing a blind raise. So, and I'm spinning into this other piece now is like, as a fund manager, what's the benefit of that? Because on that side, they raise the money first and then they go get the deal. So if you take a look at some of the biggest fund managers, private equity people on the planet, Blackstone, they raise capital first, they raise a fund, and then they close the deals. Starwood Capital, which Barry Stern, like he raised capital first and then they closed the deal, even in their beginning phases. So they started off raising the money first and then they got the deal. So the opportunity was in the market, but they went to potential investors and said, here's the opportunity, here's our background and experience, here's what we can do, and here's what we want to go do. So, I mean, if you just take a look at that alone, that should answer the question is like, what's probably which one's better? But like we said, first one, there's more certainty with the fund manager. Usually, if we talk to a broker or when we talk to sellers and we go, hey, I'm a fund manager, we have access to the money already, and we open dialogue, they're a lot more friendly. They just are. Um, and then next, we get access to better deals. Like it's easy. Like I talked to a broker yesterday. Yeah, yesterday I was leaving our office. And I was like, hey, and we're talking about a deal. He was asking me about sizing the loan on a deal that's come to market here. It actually is in Oceanside. And I was like, hey, what do you see out there that you like better? He knows I'm a fund manager, so it's a lot easier for him to say, hey, you know what? I think this is coming up, and I know this one's coming up. The conversation is a lot different when people know that you have access to the money. Next, you're a lot less risky to people. Going right back to the thing, hey, when you're a fund manager, you're already raising the money. They already know that you have access to the capital. You come across as a lot less risky. Your risk profile comes down, and that's really important. Um, Now, here's the caveat to that. Both of them have their challenges. If you're a syndicator, it's a lot easier to raise money for a deal because you can show people a deal. So people believe what they see, not what you say a lot of times. So it's a lot easier for a lot of people to do the syndication deal, but the challenge comes, like I said, that's the plus on that is that you got to have a deal or you have to work with somebody who has a deal, which is why you see a lot of people partnering that already have a deal, and then you have syndicators raising money also partnering with other syndicators. So that's a plus. So the downside of for me as a fund manager, it's harder and it takes longer. So I mean that's why you see like some of these bigger fund managers and funds that take 12 months, 18 months, 2 years, whatever. Like we've been dragging our fund out for a long time, and I continue to extend it, not because I couldn't raise the money or take the money, but because I was watching what happened in the marketplace. So I elected as a fund manager to not take in capital, to one, take it in, not get the right deal, not be able to hit our business plan, and then have to give that capital back, and then lose trust with my investors. And number two, not to just take the money in and then take on a bad deal, knowing that I needed to get a deal because I got to place capital and find myself in a situation. So I elected as a fund manager, which which take this to heart to know that I take your money very seriously. I take people's trust very seriously, my reputation very seriously. Even though to the from the outside it looks like, oh well, you take a long time, you're doing this, you're doing that. Like what happened? The market changed. Like I said, Blackstone didn't buy, Starwood didn't buy, KKR, all those people pushed off, JP Morgan and all those guys, everyone stayed. Like that's the fund manager mentality. We are going to keep our capital relationships intact. We won't just go find a deal for the sake of finding a deal like syndicators did, raise money, and you see what's going on in the marketplace. A lot of them are not hitting returns. A lot of people lost their investments, almost all of it, people not getting their money back because the market turned on them because they went off and they did the deal based on the deal, not based on sound principles of investments, which is what you have to do as a fund manager to protect the capital for the people who invest with you, and that are your partners. So let's see, what else do I have here? How does cash flow work? That was the other question. How does cash flow work? Um, in multifamily real estate, typically, if you're a passive investor, we go and we source a deal. Like in this situation, we would source the deal, we would close the deal, and then you would get cash flow based on the income coming in from the tenants paying, less the expenses, less the debt, and any reserves that we're going to put away for the property. And then that remaining positive cash flow would be split with our partners, right? Because we don't have a pref return. We just have an 80-20 split, which means 80, the investors would get 80% of the cash flow, right? That's how we did that. So that's how the castle works. But again, it's not coming from my efforts, Victor Bell. I'm not out there doing a bunch of work. My team, we would be overseeing the property management company, the professional property management company, Greystar. That is one of our property management companies that we're going to be working with in some of our deals. And then they would be doing the day-to-day work, the boots on the ground, making sure the staff and the people are doing what they got to do, and making sure that those physical activities on the asset in the property at a property location are being handled. So from a cash flow perspective, you would just basically write a check, get a check, and then we would, get our calls every month where we would do our investor updates and things like that about the market, real estate, any new potential deals we're looking at, and any distributions that we would have. So that's how cash flow works as a passive investor. You write a check, you invest, we oversee the project, and then you get a check back, which would be your distribution monthly or what's considered your cash flow. That's how that works. But again, that's done by our residents, the tenants, and things like that. So those are all the questions I had. I just wanted to address those. But the big one I really like was the fund versus the syndication model. Like, why did I choose that? What's the difference between those two? And the big answer to that is certainty. Certainty and risk. People like certainty. They like to know that you have access to capital, not gonna go run and get it after you get it. I know some people say get a deal first, raise the money second, the money will find you. That is not true. You have to go talk. Money is through people. All money comes through another human being. So you need to, or a bank or an institution or a family office, whoever you're getting your money from. We want to go straight to you guys, straight to retail investors, everyday normal people who really need these investments. So that means I got to get out to the marketplace and connect with you guys and talk to you guys about investing. Um, Now, if I have a deal, I can show you the deal. That's great, but you don't just go get a deal and money just pops up. People just, what do you have? Like that's not that isn't true. I've been doing this for 30 years, like I was talking about it with my background. And I've always had to go find the money. Like I had a deal, nooses around my neck. I have to go find the money. And at this point in my investment career, starting an investment firm, a real estate investment firm, and being a private equity real estate fund manager, I wanted to get myself in a situation where I can be a better service to my investors and talk to you guys first. Hey, here's what we're gonna do. I think that's better. So the chicken or the egg, what comes first? The egg always comes first. The egg is the capital. So that's the way that I want you guys to take a look at that. Now, if you're a syndicator, great. Go do it. Go hustle, go grind it out. And then when that's done, go find another deal, go raise more money, go do the thing. That's a great business model. I just chose to not do that anymore. Um, but I hope that helps. I hope this Q&A lands. The person that asked the question about the cash flow, thanks for asking that. I hope that also helps. That comes from the tenants. You get that every month. After everything has been settled, basically all your expenses, all the debt's been settled, any reserves we put away for the property. So that way we can continue to take care of the property, take care of the tenants, make sure that if anything comes up on that asset, we can go and we can fix whatever we need to fix to make sure the tenants are happy. Because technically, the tenants are our customers. They continue to pay every month, and that's where that cash flow is coming from. So I hope this helps, guys. Let me know if you guys need anything. If you have any questions, make sure to leave them in the comments. If you have any comments, make sure to leave them in the comments. Share this video, parts of this video. If this makes sense to you, definitely give it a thumbs up. If you like my kind of, it was a little bit confusing. Sorry about that, but my demonstration or my explanation of why a fund versus a syndication or how syndicators work versus fund managers, I hope you understood that. But basically, the risk. I mean, people just, they don't want the risk that, you're going to get a better deal if you have all cash or you have access to cash and people just treat you different. That's just the truth. And you guys know that because we see it every day. All right. So, you guys have a great one. Let me know if you need anything and share this video. Let's get after it. Boom.